it. Let's see when it starts. There's always such a lag, man. What's going on, YouTube? We have our good friend Lior Gantz here to help us make sense out of the Fed announcement that he watched and I watched part of. It was painful to hear the same old lies. But what's up, Lior? How you doing, buddy?
I'm doing good. How you doing?
I'm good, brother. You want to enlighten us on what you think's going on? Now, we were talking backstage about, as far as I'm concerned, from what I caught, I've been in and out doing laundry, that, I call it a pause because they're not raising rates at this point in time, and you called it a skip. Would you like to explain that? Because that educated me.
Yeah. So a pivot is when you go from hikes to cuts or from cuts to hikes. That's a pivot. A pause is when you stop doing whatever you're doing. So a pause would mean that the Fed has reached the level where it's confident that rates are high enough that the only thing that's stopping inflation from continuing to go down and from the labor market to continuing to stabilize is a lag effect. So essentially, we're comfortable where we are. Let's just stay here and let the lag effect come in. That's a pause. We're not there yet because, according to the dot plot, there's out of the 19 governors that vote on this, 12 still think we should either raise rates again in November or December, and only 7 say we've ended interest rate hikes. We're at that level that we can pause. So because of that, we call it a skip. So they've just skipped the meeting and they've basically delayed any big decision, which is either a hike or a pause, till the next meeting. The market, by the way, if I can, I don't know what happens if I exit the full screen. Do you see me the same way?
I see you now in the same way, yeah.
Okay, so I just want to look at market probabilities as we're doing. What I'm doing is looking at what's called CME Fed Watch Tool, and so right now, November is still 71%. The market believes 71% that they will skip again. And December, it's 55% that they'll skip. So essentially, the market believes that if they will raise rates, it will be in December or in January of 2024. That's very interesting. And in terms of when they will cut, because the Fed is likely to cut, it seems like the probabilities look really good for either June or July of 2024. Essentially, at the end of the day, right now, market expectations and the Fed expectations are very hawkish historically, because we're definitely above 5% interest rates at the Fed funds rate level, and we're going to stay there probably till elections. So I would say continue to live under that idea, because there will need to be something monumental for the Fed to reverse meaningfully or to hike meaningfully. And the reason I say that is because if we looked at the spectrum of things that can get us to a panic, none of them were actually addressed by journalists in the Q&A session. So they didn't panic over the regional banking crisis. They didn't panic over debt in the real estate commercial office space. They didn't stress over credit card debt from consumers or defaults or impending default levels. They didn't panic over China's catastrophic economic activity. And on the flip side, they didn't. And on the flip side, they didn't really stress over higher oil prices. So, to me, what I got from this meeting is that the Fed really feels very comfortable that what they've done has achieved. Just like when you try to stop a train and you pull on the brakes and you have to pull it very hard in the beginning, and then you can kind of ease into
Hmm.
the end of it. I think that's how they feel like. They feel like they have a lot of control over this process, and I'm not saying it's right or wrong, but I'm saying what they feel. They have a lot of control over this process. Stopping real hard now doesn't make sense, and stopping too slow doesn't make sense either. We need to stop the train. In other words, we need to get to this soft landing if possible. But in order to do that, we don't need to keep raising rates every meeting. We can literally just make the decision in the few days that are before the meeting as we see everything coming in: labor, rents, obviously oil prices. They did bring up uh, the possibility of a government shutdown. That was discussed a lot.
So, real quick, normally I do a roll call. I see all of you in the chat. I appreciate you all being here. I'm not going to shout each and every one of you out because Lior has informed me I only have him. Well, we only have him for 30 minutes. He's a busy guy, and it's my birthday week, and I'm going to leave town after the stream. Don't come rob the house. So I'm not going to say which day, but I am turning pretty long in the tooth this week, 43. So it's funny that you mentioned markets because markets react so strongly to things like Fed announcements. It's not so much profit and loss as much as it is news. I mean, it's both, but it's news related. So I looked at the metals markets. They look like they went up slightly after the announcement. I also looked at my brokerage account. It went up a little bit, but it's still down. So I think it's so funny how markets react to news, especially Fed news, and it's very interesting to me.
Okay.
So I thought that was years ago things were more tied to profit and loss, and now it just seems the news plays such a big part in oh look, things are up. It's just interesting to me. That's all.
Well, if it might be educational to take a case study. Okay, let's take a company that I really like. Okay, and I can go over with you and kind of show you uh, how it is tied to profit and loss. It's also tied to a lot of market expectations about the future, and it's also tied to the fact that uh, the retail public is out of the stock market.
Well, that's what I meant about news. It's expectations of the future. It's just interesting to me. But go ahead.
Yeah, no, I mean, look, one thing that's happening in the economy is that in 2022, everyone predicted that it's going to be everyone, meaning economists, predicted that it will be really bad, and they were right. And because the retail public um, acts way more on macroeconomics than on fundamental of given companies. In other words, most people do not sit around and go over financial results and listen to conference calls. They hear economic assessment. Hey, there's a recession coming. There's higher interest rates, etc., and they trade accordingly. Let's sell everything. Let's buy everything. Let's do this. It's all in broad strokes, and because the markets rose, I'm sorry, went down so much in 2022, and then money market accounts offered yields of 5 and 6%, the retail public is out of the stock market. So whoever wanted to go to leave the stock market is already gone. And what's interesting is that the retail public has not come back. So they've looked at all this rally, this incredible rally of 2023, and have just not participated. They were like, nah, this is artificial. No, it's artificial. No, it's artificial. This is just artificial. And the markets are, just keep going up. On the flip side, institutionals that have been in the markets, in other words, pension funds, insurance companies, etc., they've lived through these incredible rate hikes. They're like, we're not the suckers that will sell now, because now we've been through the ringer. If interest rates are going to come down, why would be the point of selling now? We've already gone through this entire roller coaster with 2021, 2022, and 2023. I mean, we're good. We're here. We're not selling. So you've got Wall Street not selling. That's why the markets are really close to all-time highs. But you got the public out, and I think it's just a big wait and see. So that's the stock market. Same thing can be said about housing. Housing, you see, prices are really high. The median house in the United States right now is over $400,000, and the median mortgage is $2,600. Now the median rent is $2,000. So mortgage is insanely high, but rents are also insanely high for an economy where the average worker makes just over $4,000. So you're getting into situations where the rents are 50% of your income. That's more like Africa.
Even more than that, I mean, there's this new place that went up over here where I'm at. Two new places actually. Do you know what the rent for a 3-bedroom apartment is, Lior?
An apartment, a 3-bedroom apartment. I don't know. It depends on the area, but
they're luxury apartments. It's almost $5,000. That is insane.
That's inside of the metro,
I'm just outside of the Portland metro area, but I mean, you figure someone making minimum wage, that's over $1,000 a month per person, well over, and people can't afford that. I mean, people say, "Why don't you move?" Well, I've been here forever. I pay $950 a month, which is cheap, and I can invest a bunch of money on the side. And I mean, they're luxury apartments, but it's astronomical. By the way, everyone in the chat, thank you so much. I see you. I appreciate your time for being here. It's crazy, man. I mean, that is actually out here about 2.5 more average mortgage payments, give or take, because an average mortgage payment is $2,000 or less out here. I would say that's insane for a rental.
Yeah. So as you see this environment, big institutional buyers, they're like, okay, this is going to create so much distress in the next few months. We'll see a lot of distressed sellers, a lot of motivated sellers will come into the markets then. Sellers that are able to continue to manage their portfolios. So this would be like large multi-family complexes, or just large portfolios of single-family homes. Because rents are high, they probably are either positive cash flow or just barely at positive cash flow, but they don't need to sell. So you have like a frozen housing market because the buyers think that prices are really going to come down, and the sellers are like, I mean, this is as low as it is. It's only going higher from here. So everyone thinks the other guy's wrong. So you got a stalemate in housing, stalemate in the stock market, and it's the same thing with gold. Because
you're right.
If you look at gold, it's nearing all-time highs. So the people that are holding it are like, well, interest rates are bound to come down. I'm not going to sell now. And the people that are out are like, no, there's going to be a recession. This thing is going to crash. I'm not going to buy it now next to all-time highs. And this incredible stalemate in everything is creating, and all of this is happening while the American economy is absolutely booming overall, because the world's second largest economy is stinking bad.
Well, they say China's the second largest economy. I think it's us, but anyway, I think that's a lie.
There are ways in which you can measure the Chinese economy as bigger than the United States, but there's no comparing the two in terms of their in terms of so many things. America is just the golden goose, and Americans love to criticize themselves, which is part of their greatness, I guess. But and there are problems in America. There's no, there's no sugarcoating it. But China's really the ability of the United States since the inception to uh, tackle issues and solve them is unprecedented in human history. There's just no other group of individuals assembled into a federation that have ever encountered the amount of problems and have solved them so gracefully and have moved on in this never-ending salad that is the United States of America, into more and more wealth. So the innovation system, the amount of potential, coupled with the geographical wonders that comprise America, the security of having two oceans and two great neighbors. There's so much I can go through 25 minutes of why the United States, if properly managed, could be the greatest country in the world 10 times over. But my point is that because the world's second largest economy, or the Chinese are seeing their model collapse, basically their real estate model, which is 25% of their GDP, compared, by the way, to 8% of GDP in the United States when the subprime mortgage collapsed. So just think of how big their real estate crisis is. A lot of industrialization is moving back to the United States, and you couple that with a lot of retirement from baby boomers, which means that a lot of millennials are getting those jobs that pay good, and there is work for each and every qualified person in America right now that actually is seeking a job and trains for that job. That environment where there's so much disagreement on prices, yet everyone is employed, so we're not in any sort of classical recession, is the reason that this is such a confusing time for investors and for savers and for everyone alike, because inflation is pretty high. Historically, it's very high. In other countries, this would be normal, but in America, this is extremely high. But yet, most people have active income. So at the end of the day, what happens is, because of high prices, people are employed, but they're not able to save a lot. And that's, I think, the frustrating part in this, that's causing Biden's approval ratings to plummet, and the support for more aid to the Ukraine to wane and wane, etc., as we go into an election year. So I think that there might be some dramatic changes, but they will come from the government and not from the Fed. I think the Fed is most likely going to tread very easily and just continue to be very, very stable in its decisions. Maybe another rate hike, maybe not, but higher for longer seems to be the regime. We're in very high interest rates for at least another 18 months.
You mentioned a couple things I want to touch on real quick. By the way, Gold Chick says she pays $41.75 a month in rent in Miami. She must be rich, or she was, and now she's not because of the rent price. You talked about measuring economies. The Fed says 4% inflation, excluding food and energy, which is the vast majority of our inflation right now, in my opinion, that and the currency printing. So it's funny how they present things to us as the public in the way that they want things to be heard. It's just more lies, in my opinion. And then you talked about jobs, and they mentioned that too. They said, there's more jobs than there are people to fill them. And I think that's partially true. I think there are more people to fill jobs than there are jobs available, but those people don't want to work because they're on the whole, I get the easy money from the government, aka the taxpayer.
Oh, of course.
It's just terrible. I mean,
of course, we have a very low participation rate. So only 62% of Americans are part of the labor force. It's like 150 million Americans. I think 125 full time, 25 part-time. So of course, but that's every Western economy. I think that in general, that's not the problem. That's not the issue. The issue is deglobalization. The issue is um, that politics is interfering with oil prices. And I'll give you um, an idea of why that is. So forget Russia not selling to Europe and selling to China and India instead, and Europe relying more on LNG from America and on oil from Algeria and Turkey and Azerbaijan, etc., and Norway. Um, Fine, maybe that has some impact on higher oil prices. Maybe the cuts from OPEC do as well. But the fact that you have an administration that's 100% against fossil fuels has created a situation where no one has built a refinery in ages, and there are no new refineries that are scheduled. Because why would you, as an entrepreneur, build the one thing that the government hates, and they will regulate the hell out of you? So this bottleneck in
Well,
refineries.
they
Go ahead.
love oil because it makes them a lot of money. They like to act like they hate it, but go ahead.
Um, uh, I'm sure there's that level of sophistication, but as an investor and an entrepreneur trying to justify for investors building a refinery in America right now, that it's very, very tough. So um, refiners, as you can see by their share price, are exploding up in price, and that's because there's so few of them to fill the demand. Um,
You're right. I'm a shareholder, and my portfolio reflects that. Go ahead.
yeah. Okay. So my point, I think, is that in the next 2-3 years, as we continue to see deglobalization, and deglobalization just means that countries sell to other countries, not due to economic considerations alone, which is what globalization is, right? You seek the arbitrage and differences between countries and on wages and regulation, etc. In deglobalization, you seek to deal with your allies, and that is costly. So, in this kind of world, which we're fragmenting into more and more, inflation is more of a constant. And that is another reason why countries want to rely on their own currency um, and sell more dollars. So you're seeing countries that are the biggest treasury holders, like China and Japan, selling way more treasuries than ever before, actually buying some gold to offset that. And I think that that will continue. So deglobalization is coupled with the de-dollarization that contributes to inflation further, and I think that that trend is not going to stop.
I agree with you. So let's talk because I know we have about 8 minutes left because you're a busy guy and I'm getting the F out of Dodge because it's my birthday week and I'm off. Don't call, don't write. Phone won't have service. Let's talk solutions. So you talked about how shareholders and asset holders aren't selling, and I am both. And you're right. I'm not selling. I'm buying up whatever I can. What do you think for the common person, which we all really are? I mean, we're all just trying to, do the best we can. It doesn't matter
Sure.
what our portfolio says. We're just people.
Hmm.
Because I'm, my stock portfolio tanking. Day to day goes up, goes down. Metals, they are what they are as far as that goes. I am buying metals. I am buying assets. I am buying, well, what's metals are. I'm buying, markets. What do you think the solution is for the common person like all of us here today?
Okay.
And I did put a disclaimer that you and I are not financial advisors. This is merely our opinion. So let it rip.
Yeah. Yeah. Um, One thing I like is I like the flexibility of high yielding money market accounts. The reason is if you can get 6% and have the availability to withdraw your funds at any given point, that is like getting 0.5% monthly for the option of doing whatever you want. In other words, in a market crash, you get paid to see it. Okay. If the real estate market slows or tanks, you get paid 0.5% a month to watch it. I love that, and I think that for anyone that can get a fixed rate of return with an immediate withdrawal option, you should consider having new money in that instead of uh, putting it either in investments or equities, etc. Secondly, if you are not big into timing, if you're more into fixed income, uh, credit funds. So best if you're an accredited investor, but if you're not, look for options for non-accredited investors. Credit funds are paying between 8 and 12% fixed right now. Um, the S&P 500 has historically returned about 8.5%. So getting 8 to 12% fixed without any market volatility, that is something that we haven't seen since the mid 90s. So that's second on my list of what I really like right now. And I'm personally I just signed more credit um, into a new credit fund. So I'm doing that myself, and then
Are you
um,
handing out loans? Because I'm poor. I need more gold and silver. You want to help a brother out?
we can talk offline. Um, and third, I like my core portfolio. So my core portfolio is comprised of I think like 17 companies, and those to me are the best companies in the world. I'm absolutely in love with their management teams. I think that they have durable competitive advantages. They're not monopolies, but effectively they're so good at what they do that they're legal monopolies. So that's how I like to call them. Obviously, they're not. They have a lot of competition, fierce competition, but they're just not able to crack and penetrate like these companies have. And you might know some of them. And I know where I like to buy them. So what I do is just accumulate in droplets. So just buy when I think the price is good in very small doses and over time.
I
And
love
just,
that.
yeah, very small doses over time. Just build a portfolio nice and slow. And
Yep.
if there is a big market crash, that's when I I already love them. A market crash just means Wall Street is selling out of them, not retail. And when Wall Street sells out of something, you have to take advantage of those periods. Otherwise, um, you can't really generate good returns. When Wall Street is out, you have to be in. You have to. And when Wall Street is in, which is 80% of the time, you can just buy in small drips, and that's it. Because when Wall Street is in, their ability to price something is going to always be, by definition, better than yours. So I think that with that level of humility, that hey, the collection of hedge fund managers in the world probably know better about the security than I do. So I'm just going to buy a little bit here and focus on companies that are not in problems. That is my big lesson or message to everyone. Just
You,
don't look for these turnarounds. Look for companies that are actually that the market agrees with you that they're doing something well, but it's not pricing them like they can't do anything wrong.
you
Um,
just said so much that resonates with me, Lior. I
that's
agree
good.
with I agree with you that we need to. So what I do is I treat metals and stocks the same way. If I have a few, let's say I come in at $200, $300, whatever it is, I'll allocate a certain amount that I can afford into my portfolio and my metal portfolio in physical. And I only do metal and physical. And you talked about Wall Street's in 80% of the time. You got to be in when they're not. And that is kind of a Warren Buffett thing. He talks about going the opposite of the masses, and you also mentioned, and I'm going to divulge a little personal information here. You mentioned the percentages that Wall Street produces. I happened to make 4,700% return on medical stocks, and I use air quotes for that during 2020 because while I disagree with the whole push, I saw where it was going. I didn't see it enough, so I only made about 20 grand. I didn't have enough invested, but I made $47 for every dollar invested. So what I like to do, oh man, so I beat Wall Street percentages on that one. Now I will say with the current pushes coming back, in my opinion, I am back in that market. It's not doing stellar so far, but I have bought 20 times the shares this time. And if I make, a third of what I made before, I'm sitting pretty. You have to use your head.
Yeah, I agree.
And you have to be spread across different markets, and you're not always going to be right. Well, and you got to be spread, you got to be spread across, you got to be diversified, and you're not always going to win, but if you hedge yourself correctly, you're going to be okay because one thing's going to go down, one thing's going to go up. I mean, it's very strategic. I don't have a massive portfolio. People joke online because I'm stacking 20, 40, 60, 80 ounces a week, whatever it is. It depends on the week. They're like, oh, he's got big bucks. I don't. I'm poor, but poor is a relative term because I'm poor compared to Donald Trump, but to the average American, I am Donald Trump. So, it's all relative. You know what I mean?
Yeah, for sure. It's all look. At the end of the day, it's fun to use your head, and that's why I think that if you can start with a few companies that you start to understand and really like their management, I can't stress that enough. Just go on a conference call, listen to the CEO. Do you love him? And if you do, that is worth something now, because now you've got you're using your judgment to understand that. And I can tell you there are a few Elon Musks and a few Steve Jobs and a few Jeff Bezoses that are hiding out there in plain sight. And all you need to do is spend some time on this, and in 20 years you and your children will be very happy that you did. So it literally takes an hour to understand if you're listening to Steve Jobs. That's it. It doesn't take more than an hour. So my point is, you don't have to read books forever. You don't have to listen to a gazillion podcasts. Take the S&P 500 or the NASDAQ 100, start picking companies, listen to conference calls for 30 to 60 minutes to the latest conference call, and just put a rating of 1 to 10. Is this amazing, or is this whatever? And man, you will, in 2-3 years, you will have a sense of the best out there, the best that's out there on the American stock market. And if you can find 2 or 3 or 4 of these for your entire life, that is amazing. Just consider that the fortune of Warren Buffett has come from about 16 companies.
Coke was one of them. That was his blue chip. So I know you have to go. I don't want to keep you, man. It is always such a pleasure. I hope we can do something again. Every time you're on here, I learn something. I think everyone else learns something. I do have to take 1 minute to mention somebody in the chat, and I love all of you, but there is a big time heavy hitter in here, Smart Silver Stacker. If you don't know him, you need to know him. I like to play a game with him. He's been doing a lot of live streams. I love to super chat the guy because I know they're always appreciated because Google doesn't pay us anything. And he's very smart, but I like to play a game with him. I like to say things to make him try to crack up in the chat, and sometimes I get him. Well, when he's on a live, sometimes he'll start chuckling and cracking up, and I'm laughing thinking about it. So if you don't know Smart Silver Stacker, the guy is very good, very smart. Go check him out. Go watch, but don't just check him out. Watch him. We only benefit if we interact and we learn and we talk and we converse, like what we're doing now, which is what I love about live streams. And Lior is always just such a friggin' wealth of knowledge. So I appreciate your time, sir.
I'm always glad to come, and it's a great atmosphere. I'd love to come again.
I would love to have you. I mean, if you want to, come up with something or whatever. I mean, I can always email Christine and we can come up with something if you're willing. But it's always a pleasure to have you on my channel.
Thank you, sir.
Thank you. Is there anything else you want to add? Because I know you have to be out of here about 4 minutes ago.
I think that in the next 2 months here, between September and November, the market is really going to think about how the soft landing thesis is holding up, and if it's holding up, then you need to change your thinking, because the likelihood of a recession is probably diminished. It's in your head, but it's not in reality. On the flip side, if we start seeing more signs of a recession, you need to immediately look at how the playbook for recession is that you built. But we will know between now and November. You will know whether or not we're just not going to have a recession, or we will. So I think the next 2 months are crucial. And obviously we're going to cover it on our newsletter at wealthresearchgroup.com.
Yes, go check that out, actually, guys. Wealthresearchgroup.com. Absolutely. Lior is smarter than we can all ever hope to be, in my opinion.
Okay. Well, thank you.
Except for maybe Smart Silver Stacker. He's pretty smart, too. The floor is yours, Lior. I mean, I'm done. If you got anything else, that was a great exit.
No, I actually have to go.
All right, brother. Thank you very much. I appreciate your time. All I got to say is keep stacking.
Keep stacking.